Before every flight, my first officer and I check the load closeout and the performance data. That includes outside air temperature, runway length, aircraft weight, pressure altitude, and wind direction, just to name a few. It's called running the numbers. Those numbers tell me one thing with absolute clarity. Does the aircraft have enough energy to get the airborne and climb out safely? Not a feeling, not an opinion, a number. Now, here's what most investors never realize. The best businesses in the world run on exactly the same logic. And there is one number, just one, that tells you whether that business has the energy to compound wealth over time or whether it's just burning fuel and going nowhere. That number is return on investment capital, ROIC. This is Captain Pierce. Welcome back to SkiesCapital. Think clearly, invest better. Let's go. Now, before we get into how ROIC works, I want to address something. Most investors spend the majority of their time tracking three things: earnings per share, revenue growth, and PE multiple. And look, I get it. Those numbers are everywhere. They are on every earnings call, every financial news headline, every stock screener. But here's the problem. Earnings per share can be managed. It can be distorted by accounting choices, shares, buybacks, and non-cash items that have nothing to do on how the business actually is performing. Revenue growth, top line growth means absolutely nothing if the capital return to generate that growth earns a poor return. A company can grow revenues aggressively and destroy shareholder at the same time. And the low PE multiple, that can signal genuine undervaluation, or it can signal that the market already knows this is a business earning weak returns on every dollar it puts to work. The investors who build real long-term wealth, they do not start with those three numbers. They start with a different question entirely. What does this business earn on its investment capital? That's the question ROIC answers. And once you understand it, you can never unsee it. Before we get into the mechanics of the ROIC, I want to show you why it matters. Charlie Munger said it better than I ever could. So take a second here and read this quote on the screen. Here's the idea. Bad businesses drag returns down. Great businesses lift returns up. Now look at the mathematics here. A $10,000 compounded over 30 years with a 6% ROIC would produce over $57,000. But with an 18% ROIC, it becomes over $1.4 million. Same money, same time, different business quality. And I need to repeat that. Same money, same time, different business quality. That is why ROIC matters. So let's start out simple. What is return on investment capital? So let's define IROC clearly. Return on investment capital asks one question. For every dollar a business puts into work, how much after-tax operating profits does it earn back? IROC equals NOPAC divided by the investment capital. NOPAC is the operating profit after tax. Investment capital is the capital tied up in the business. So in plain English, IROC tells you how efficient a company turns capital into profit. If a business puts $1 billion to work and earns $200 million in after-tax operating profits, that's a 20% IROC. If it only earns $5 million on that same billion, IROC drops to 5%. Same capital base, very different business quality. And that is why IROC matters. A company can report positive earnings and still destroy value if its returns are too low. That's what IROC reveals that earnings per share often hide. Now, look at the scale on the right. Above 20% is outstanding. 15 to 20% is strong. 10 to 15% is good. Below 10%, you're entering weaker territory. So the line on the right, the cost of capital, somewhere around 8 to 12% for most businesses, that is the threshold that matters. Now, let me give you 4 reasons IROC belongs in the center of your framework. First, it reveals the moat. High ROICs over time usually signal a real competitive advantage, not just a lucky year. Second, it checks earnings quality. A company can report strong earnings and still require too much capital to produce them. ROIC exposes that. Third, it grades the capital allocation. Growth only creates value if the return on the capital are high enough. If they are not, growth can actually destroy value. Fourth, it gives valuation context. A high multiple can be justified by a high ROIC. A low multiple can can be a trap when ORIC is weak. ORIC tells you what the valuation actually means. Without ROIC, it's like asking me to fly the jet with only half the instruments. In the cockpit, we don't just scan the instrument panel and hope for the best. We run a checklist every time. I do the same thing with IROC. Same 4 questions every time. First, IROC above the cost of capital. If it is, the business is creating value. If it's not, it may be destroying value. Second, is IROC durable? One good year means nothing. I want to see performance across a full cycle. Third, how does it compare to its competitors? IROC only matters in context. Compare companies to their peers, not a different business model. Fourth, is management reinvesting at a high return? Because growth only helps if the capital behind it earns attractive returns. Follow the capital. That's where the truth usually lies. Now let's talk about the 4 ROIC red flags. First, ROIC below the cost of capital. That means the business may be destroying value even if the earnings are still looking positive. Second, falling ROIC with rising debt. Returns down, leverage up. That is usually a bad sign. Third, ROIC boosted by a one-time item. Asset sales, tax benefits, or accounting noise can distort the real picture. I want to see normalized returns, not cosmetic ones. Fourth, aggressive growth with weak ROIC. Growth does not fix weak returns. It usually amplifies it. Those are the 4 red flags: low returns, falling returns with more debt, distorted returns, and growth without value creation. That is what I'm watching for. Now, let's look at the other side. 4 signs ROIC is telling you something generally good. First, high ROIC sustains across multiple business cycles. If the company can keep returns high through recessions, inflation, competition pressure, that usually points to a real structural advantage. That kind of durability is one of the cleanest signs of a moat. Second, ROIC improves as the business grows. This is one of my favorite signals. It means the company is scaling efficiently and earning more on each dollar of capital as it gets bigger. That is the engine behind many of the best compounders. Third, management reinvests at high returns. That is what separates a good business from a great long-term investment. If the company can keep taking retained earnings and putting them back to work at a high ROIC, the compounding can become very powerful. Fourth, ROIC stays well above its peers. ROIC always needs context, but when a business consistently earns higher returns than its direct competitors year after year, that usually signals a real operating edge, not just a lucky stretch. Those are the green lights I'm looking for. Higher return than last year, returns that improve with scale, management that can reinvest intelligently, and a business that out-earns its peers on capital. When a high ROIC is durable, scalable, and repeatable, you may be looking at a true compounder. Now let's make the compounding mechanic visual, because this is where it all comes together. 3 scenarios, same basic idea, very different outcomes. Scenario A, high ROIC, high reinvestment. This is ideal. A business earns 25% on capital and can reinvest most of their earnings back into the business. That means each new dollar put to work earns a very high return and then gets reinvested again. That is real compounding. This is how great businesses create extraordinary value over long periods of time. Scenario B, high ROIC, low reinvestment. Still a very good business. Returns on capital are high, but the reinvestment runway is short. So instead of putting most of that cash back into the business, management returns more of it to the shareholders through dividends and buybacks. That is still attractive, just a different compounding profile. Scenario C, low ROIC, high reinvestment. This is the danger zone. The company reinvests heavily, but at a weaker returns. Revenue may be growing, management may call it strategic, but if the returns on capital are below the cost of capital, value is being destroyed, not created. That is the trap. Growth does not help if the return behind that growth are poor. So before you celebrate revenue growth, check the return on capital. Growth only creates value when the returns behind it are high enough. Before we go any further, one thing needs to be clear. ROIC does not exist in a vacuum. Industrial context matters. Look at the 3 groups on the slide. Technology and software businesses are usually asset light. They do not need much capital to grow. So strong ROIC can be very high, often 20 to 50% or more. Consumer staple businesses usually sit in the middle. Strong brand, steady demand, decent pricing power can support ROIC in the range of 15 to 30%. Industrials and railroads are different. These are capital intensive businesses with heavy asset bases and ongoing maintenance needs. So the strong ROIC there may be closer to 12 to 20%. That is the key point. Always compare ROIC within the same industry. Railroads earning a 14% ROIC may be exceptional. A software company earning 14% may be mediocre. So the real question is not whether the number looks high in isolation, it's whether this business earns better returns than the direct competitor facing the same economic reality. If it does, and it does it so consistently over time, that is evidence of a real structural advantage. If it doesn't, or the gap is shrinking, the moat may not be as durable as the story sounds. ROIC is only powerful when you read it in the right context. Now, let's bring this all the way to valuation, because this is where ROIC becomes actionable. Look at the two businesses on the slide. On the left, you have a company trading at 32 times forward earnings with a 35% ROIC sustained for more than a decade. At first glance, that looks expensive, but ROIC changes the interpretation. The business earns exceptional returns on capital, and it has done so consistently across time. If management can keep reinvesting at anything close to those levels, that premium multiple may be completely justified. You are not just paying up for earnings, you are paying up for a business that can compound capital at an unusually high rate. Now let's look at the right side. This company trades at 9 times forward earnings with a 5% ROIC that is declining. That looks cheap, but cheap compared to what? If the business only earns 5% on capital and its cost of capital is higher than that, then growth is not creating value, it's destroying it. So that low multiple may not be a bargain at all. It may simply reflect weak economics underneath the surface. And that is the key point. A high multiple on a great business can be rational. A low multiple on a weak business can be a trap. Without ROIC, you are just comparing price tags without understanding what you are buying. ROIC gives multiple meaning. So let's bring this in for a landing. In aviation, we do not fly by feelings. We trust the numbers. And in investing, ROIC is one of the numbers that matters most. It tells you what the business truly earns on the capital it puts to work. Not the story, not the headline, the underlying economics. So here's the takeaway. First, high ROIC above the cost of capital is a sign of a real business quality. Second, compare it across time, across cycles, and against peers. Third, watch what management does with capital, because reinvesting in a high return creates value and reinvesting in a low return destroys it. And fourth, use ROIC as your quality anchor before you ever touch the valuation. Get ROIC right first, then evaluate the multiple. Because ROIC does not just tell you what a business earns, it tells you how powerful that business really is. This is Captain Pierce with SkiesCapital. Think clearly, invest better. For educational purposes only, not investment advice. See you on day 14.